in front of my office. Okay, so now we're going to switch gears from the income statement and start talking about the balance sheet. And then just to kind of give you a little bit of foreshadowing about what the rest of the class is going to look like, once we kind of get the basic financial statements in order, then we're going to start looking at detailed computations, calculations, and estimations involved in preparing these financial statements. So up until now, it's been pretty straightforward. Sometimes I'll give you a little bit of a trick, like, oh, do you include this, do you not include this? But the way of calculating, say, depreciation has always been, I tell you what depreciation is, and you just write it down as an expense. And we're going to move in the direction of actually figuring out how you compute those values for a particular company under different circumstances and get a little bit more sophisticated. Okay, so the balance sheet, we've talked about this a little bit broadly, but now we're kind of moving into the specifics. This is telling us how a company is doing on a particular date. Okay, so at the end of the year, you measure, you count up, you look at everything you have, you take stock, and that's what you tell your investors. The problem with that kind of approach is that you present your financial information to your investors, and then a day later, if you sell off all your assets, you don't look very similar to the information you just presented them, okay? So you can only tell them, you know, here's how we look right now, and then as soon as, you know, things change, that information is somewhat stale. Now, fortunately, we are required to provide financial information every quarter, so it's usually at worst 3 months stale. And if there are significant changes to the company structure, they'll probably disclose that in some kind of press release or news release. But nonetheless, your balance sheet is really only telling you what you can count on at a particular point in time. Okay, what is it specifically telling you? Well, it's telling you here's what the company owns, and then here's the subset of people who have claims to all of those assets. So the debt section is, or the liability section is telling you, here are the people who have lent money to the company, and and then the equity section is sort of telling you, here's the residual, here's what's left over. And that includes the initial contributions of the owners plus any income that was retained within the firm. Okay? The idea behind the balance sheet is to give investors a picture of the company, how liquid the company is. What does liquid mean? What does liquidity mean, not in the water sense, in this sense? Okay, so how well the company can convert its current resources into cash. So when you think about a going concern, remember a company that's going to keep working or keep existing, and they buy a machine, how should I think about the way in which that machine is going to help them get cash? How is that machine going to help them get cash? Well, let's talk about a going concern where they're not going to sell their property, plant, and equipment. So what are they going to do with it instead? So this is a company that builds computers, and they buy the machine in order to make the computers. Okay, what are they doing with the machine? Okay, so first they have to make the product, okay? Then they take the products as finished products, and then they sell those products. So that asset, it takes a long time before that thing's going to turn into cash, okay? On the other hand, if I have something like a sale that I make this year, okay, and I give somebody the computer itself, and they just say, I'll pay you in a month, I already have made the sale, and I have an accounts receivable, which is a lot closer to cash, right? The accounts receivable means all I have to do is, you know, collect the cash. The plant or the equipment, I have to first make the product, then I have to sell the product, then I have to collect the cash. Okay, so that's sort of trying to explain how far things are away from being liquid. Okay, so when I think about liquidity, my balance sheet is going to tell me how close it is to being, you know, cash. Another thing I want to know is how solvent the firm is. That is, the firm has a bunch of liabilities that it needs to pay, whether it's to suppliers or to its bondholders, and I want to know how well will it be able to make those payments. Okay, is it solvent? And then how flexible is this company? So let's suppose the company is contemplating a merger with another firm. And they say, oh, well, you know, this firm would be a perfect fit. It's got all these characteristics that we want, and they have this great opportunity. Can they take advantage of that opportunity? And how would you know that? So if the company has no cash in the bank, then it's a lot less flexible than if it's sitting on a big pile of cash. Okay? If the company has lots and lots of debt, then it's less flexible than a company that doesn't, because even if it doesn't have cash, it could go to the bank and say, hey, can I please borrow some money? But if it's already taken out hundreds and hundreds of thousands of dollars of loans, it's going to be more difficult. So we want to know sort of how well can I respond to opportunities that come in the market, and I can only tell you that when I know how flexible the firm is. Okay, so those are the kinds of things we want to know about our company, and that's what the balance sheet is going to tell us in part. It's not the only thing, and it's not everything, but it's going to serve some of those purposes. That's so incredibly loud. Okay, so what are you going to see on the balance sheet? So the first thing you're going to see, and you all know about these, you're going to see the assets. Now, there are things that, you know, people just use the term asset in regular conversation, and then there's the word as we define it as accountants, okay? So accountants have a very specific definition for what's an asset, okay? And then they have an even further specific definition of whether the asset is recorded on your financial statements. So when we're thinking about the word asset, we're not just thinking about, you know, is it in some sense a good thing, but we're thinking of, is it something that the company is going to show on its balance sheet or not? So how do we define an asset as an accountant? Well, first, it has to be a probable future benefit. What does that mean? It means at some point down the road, maybe it's a long time from now, maybe it's pretty soon, we're going to get something, an inflow of cash, or we're going to be forgiven some liability as a consequence of this item. Okay? So the first thing is it's going to result in future cash or future discharge of a liability, reduction. Okay, that's number one that's required. The second that's required is it has to be obtained or controlled by the entity. And this is not so much a legal definition of control, but it does come into play. So there are certain assets that you'll hear companies talk about that aren't on their financial statements because the company lacks genuine control. So where I live, there's a Sheraton or something, I think something like that, right across the street from a building I frequent. And there's this employee entrance. And above the employee entrance, it says, this door is for our biggest assets, comma, our employees. Okay, I guess they're trying to make the employees feel good every day when they walk in the door. I don't know. Anyway, are those employees on the balance sheet of the Sheraton? And the answer is obviously no. And well, not obviously, maybe the answer isn't obvious, but the answer is no. And why can they not include the value of all their employees or their labor or their workforce? And it doesn't really meet condition 2. Okay, human resources are not controlled by the firm. People can always quit, they can leave. Yes, it's true, they have contracts, and there may be some cost to an employee from breaking those contracts, but generally, contracts are at will, and the company does not obtain and control / own the future benefits that are associated with the labor of these employees. So we can't record them on our balance sheet, even if they're really great, okay? And so in some companies, you might think there's something significant that's missing, which is the talent pool that this company is able to attract, right? Some of these internet firms, they've got all these really cool, young, smart people working there, and that's part of what makes them so successful. Nonetheless, that's not going to show up on their balance sheet, okay? And then the final thing is, it has to be the result of past transactions or events. So remember we talked about contracts, and we said, well, when can you recognize revenue? Well, you can only recognize revenue when part of the contract has been executed. Well, what comes along with recognizing revenue would be you'd recognize an asset, right? So either cash or accounts receivable or something like that. Well, unless the event has already occurred, meaning half of the contract has been executed, you can't record it. So we cannot include on our balance sheet future benefits that will come about as a result of future events. Okay? Part of the transaction must have occurred in order for us to consider it to be an asset. All right, liability, same idea here. It's a probable future sacrifice, so this means we're going to have to give up money instead of get in money, or give up some other form of an asset, or incur some sort of additional obligation. And why do you have this obligation? Well, it's because you've already engaged in some activity, so it's presently. It's not that a year from now we're going to go out and borrow money. Let's say we're sure we're going to need to borrow money. Would we consider that borrowing a liability now? No, it's only the stuff that's presently our obligation. Okay, so it has to be the result of past transactions, and it has to be an obligation that we presently owe. So we are currently going to have to make that payment. Okay, finally, owner's equity is just everything else. Now, I know that doesn't sound very appealing, but really the way you're going to think about owner's equity is if it doesn't qualify as an asset and it doesn't qualify as a liability, this is where it's going to fit. And this is what kind of drives the whole balance sheet equation, right? If I have assets equal liabilities plus equity, if I tell you what all my assets are and I tell you what all my liabilities are, do I have any flexibility in the equity section? No. I mean, it has to be whatever's not accounted for yet. Okay, so it is really this residual interest in the net assets of the firm, net assets being assets minus liabilities. So equity, you could just rewrite this equation as assets minus liabilities equal equity, and so once you have A and L, there's nothing left to say about E. Okay, it doesn't mean that equity isn't important, and it doesn't mean that equity isn't directly affected by certain transactions. It just means that it is this residual interest. So if I account for something as an asset and it's not a liability also, then it belongs in the equity section. Okay. Now, what are the problems with the balance sheet? So I already told you one, which is it's just telling you what happens at one day in the company's life. And so if you, the next day, decide to make some big changes to the firm, the information is really very short-lived. The more broad limitations are we have to make decisions about what we can include and what we cannot include based on measurement and some of these criteria. So I said, well, you have to control it, so you can't include the workforce. In some companies, wouldn't knowing who's working there and what the quality of those employees matter and affect how you value the company? Right? If you've got the smartest scientists and the most loyal people, don't you think you're going to be more successful than a company that has turnover? You know, everybody's leaving every other day and they're constantly downsizing and then upsizing and rescaling and nobody has any loyalty for the firm? Sure, that matters. The balance sheet, our accounting balance sheet, isn't going to really capture that. Okay? How do we decide? Sometimes we exclude things that we ought to include, and sometimes we include things that other people might argue don't belong there. Okay? Then once we decide, okay, we're going to include it, okay, so yes, we're going to include it, now we have to figure out how to measure it. And this is where we come into the discussion that we had sort of way back when on the first day of class. How do you measure how do you measure the value of something? And we've talked about different options. You could try historical cost, which is how much you paid for it. But some people would argue that's not particularly helpful because what you paid for it may not reflect how much it's worth. Okay? So then there are some adjustments you can make to historical cost, like historical cost minus depreciation, or historical cost evaluated for impairment. So even if you don't depreciate it, you would check every year to make sure it's not overvalued. Okay, so sort of a conservative approach which says, look, as long as we're not overstating what we've got, things look okay. Or we could do something very different, which would be use how much it would cost us to buy the asset today. Now, let's suppose you were an accounting member sitting on the FASB, and you're trying to figure out whether companies should use historical cost or replacement cost. Why would you reject replacement cost? What would be some good reasons not to use replacement cost? Yep. Okay, so why is that a problem? Okay, but if the company genuinely had a big loss, wouldn't that be the right thing to do? No? Okay, yeah. Okay, well, let's say we use historical cost minus depreciation. So we're not totally naive. We understand that there's some depreciation. So we've been depreciating the asset. So we said historical cost minus depreciation, and we versus how much it would cost us to replace this asset right now. How do I figure out how much it would cost me to replace this asset right now? What? Yeah, but so who do I call to find that out? Like, do I go to the supplier of the equipment and say, I would like to replace this asset, and how much does it cost me to do that? And then I just write that number down? Yeah. Okay, so you could potentially call somebody in and say, look at this. How much would I have to pay for that? Okay. Yep. Okay, so it might be expensive just to hire someone to come in and tell you what they think you would have to pay, hypothetically, if you bought it. Okay. What's the other problem? In addition to it just being expensive to do that. Okay, so let's say now we're going to add more to the cost by requiring 5 estimates. Okay, so let's say we can do it, and let's say everybody's free. So I'm going to even throw out the expensive part. Why is it still a bad idea? Okay, so am I planning on I have a perfectly good asset in place. It's working. I'm using it in the firm. Am I planning on replacing it? It's perfect. It's in good condition. Why do I care what the replacement cost is if I'm not going to replace it? Right, so what was the basic explanation for why I don't, what is the story I'm telling you which says don't use replacement cost? Going concern. Going concern says we're not really interested in how much it costs to replace the asset, and now I'm going to pull the cost. It's expensive to do. Lots of people might have different opinions, and so if I'm not so ethical, I might call up my brother-in-law to appraise it rather than some person who would do it honestly and unbiasedly. And there may not be any other assets that are exactly the same because, once it's in place, I've added a lot of, special personal quirks to this machine. It may be very hard to measure that number. So it's hard to measure, it's expensive to have somebody come and measure it, and it can be biased. So we have all of these limitations which would say, what does that tell? Why would you want to know replacement cost? Why would that be a better thing than historical cost? Okay, so on the other hand, so now I probably convinced you replacement cost stinks. Why would replacement cost be a good idea? Why is it in what way is it superior to historical cost? Okay, so clearly, if I was having a problem and I needed to replace it, it might tell people how much I would have to pay to replace it. On the other hand, of course, I would, instead of, because I'm going to have to replace it, I'm going to experience some sort of loss there, right? Because I have to go out and replace it. So if I do replace it, that'll show up on my financial statements when I buy the new one. Okay, so I don't really need replacement costs for that one. Any other things? Reason? Yeah. Okay, so it's at least going to tell me something about the market value of my assets, and as an investor, don't I care about isn't the market value basically telling me something about the future cash flows of the asset? And so it's not that replacement cost has no value at all, it's just, do we want our balance sheet to be the same as stock price? Do we want earnings per share to just be equal to price per share? Do we want the book value of assets to always equal 1, like price to book to be 1? And the answer is no, because we think we're telling you something different from the stock price. The stock price is people's interpretation of what's going on in the financial statements, okay? But they're not the same, it's not exactly the same as the balance sheet. Okay, fair value would be also some sort of way of, if we don't have a market value, we would estimate the future benefits to the firm, okay? Or what about net realizable value? So this is not how much we would have to pay for it, but this is how much we could sell it for. What comes into play again? Going concern. I'm not planning on selling it. It doesn't really matter how much I could sell it for. What would investors even do with that information, because I'm not going to sell it? On the other hand, can you come up with any reason why I might want to know what I could sell it for? Yep. Okay, if I'm going bankrupt, yeah. If I actually think knowing that information would change the manager's decision. So maybe I wasn't planning on selling it, but if all of a sudden the price skyrocketed, maybe I would sell it. Okay, so as long as it wouldn't sort of detract from my being a going concern, maybe I might make different decisions, or if I was an investor, I might try and influence the firm to actually make different decisions if I knew accurately what the value of the thing was. Or, maybe I can just predict what the future cash flows are of the asset and discount them to the present, which is essentially what the market is doing with my firm. Again, all of these require a couple of things that historical cost doesn't, which is they all require you to get estimates or have estimates, have forecasts, predictions, and they add more noise into your financial statements. Okay, historical cost, we know what we paid, and there's no ambiguity there, right? There's no way of, so what historical cost buys us is some of the advantages that we talked about a long time ago, which are, it is representationally faithful, at least on the date of purchase, okay? The question is, does it all of a sudden stop representing what it meant to represent as the value of the assets change? Okay, so given we make some choices, now mind you, historical costs we use a lot, but that doesn't mean we only use it. There are times when we use replacement costs, there are times that we use net realizable value, and there are even times when we use discounted future cash flows. Different accounts are measured differently, and we'll talk about which ones are used where. So you can't just say everything is at historical cost. It's not, and even historical cost less depreciation. Okay, so we're going to have estimates. That's a problem too. All right, so let's talk about the biggest limitation that some people would argue that where accounting fails us the most is that there are some obvious assets that people care about that we leave off the financial statements. And we only include stuff if we control it, and if it's been partially executed, and if we can measure it, all those things that were required. And so here are the things that we often leave off that we think are important in valuing a firm, but accounting just completely punts on. So human resources, we talked about. Okay, we don't know how to measure the value of our employees. We don't own them either, so that's the second reason we can't include them. When we develop patents, trademarks, brand names internally, we don't know how to measure those either. Okay, so let's suppose we're working on a project internally. We come up with a great idea. We patent it. We trademark our brand name. We do all sorts of things. How do we decide what the value of that thing is? So we could use historical cost and just say all of the money we spent doing research and developing that idea could just be added to its value. Why does accounting not let you do that? Yeah? Right. Okay, so the reason we say no on research and development and internally developed intangibles is that just because you spend a lot of money, it doesn't mean you got something successful. Even if you patent it, there are companies that have like hundreds of thousands of patents, 99% of which do absolutely nothing useful. Okay, especially a patent that is sort of replicating something else but in a marginally different way. You can get a patent for it, but it doesn't actually necessarily change the value of the firm. So the reason we don't allow it is it's so hard to measure the value of the item. The expenditures are not a sufficient measure of value. Okay, so for example, let's say I go out and I buy an asset, a piece of machinery from another company. Well, that seems pretty clear. It's, I'm paying a fixed amount for it. Now let's say I'm going to have research and development going on in my firm. Well, I could pay $100,000 to my scientists, and I won't monitor them at all. Now they can take that money and they can buy, important equipment and do all sorts of experiments, or they can go to Tahiti for a week and take the whole department and have a really good time. Now they'll come back relaxed and ready to work again, but are those two expenditures equivalent? And since we can't really evaluate the quality of the expenditures, accounting just says, nope, you got to leave it off altogether. So what will happen? Well, there'll be some companies that have really good stuff that won't be measured, and some companies that have none of this stuff. It also won't be measured. They'll look the same from a balance sheet perspective, but they'll be different. How will they be different? Well, you're willing to pay a premium for an iPod over a regular MP3 player. Why? Because their R&D was more successful and led to a better product, and it will eventually show up in a sales premium. Okay, so yes, it's true. It's not going to show up on their balance sheet as this great idea, but it will eventually make its way into the financial information. Right? The company will be more successful. Yep. Yeah, so when we spend, so this is talking about whether it's an asset or not, okay? So what we mean by is it an asset or not is, let's say I spend $1 million on research, okay? So there are two choices we could make. We could either, okay, have an asset called research. Okay, I'm making this asset up, right? For $1 million and cash of $1 million, which is what we spent. Or we could have research expense or cash. Which of these two things do we do? And the answer is we do number two. We are not permitted to do number one. In both cases, we've spent the money. In some cases, it's successful. No matter what, whether it's successful or unsuccessful, all firms have to record it as an expense. Now, you could say, well, let's say everybody's ethical. All managers are really ethical. You should let them tell you how much of their research was successful and let them actually demonstrate, they can expense the stuff that was unsuccessful and not the stuff that was, and they can record as an asset. So let's say 50% of our money just ended up being on stuff that turned out useless, and 50% of it was good, so I should have a $500,000 asset and a $500,000 expense. Now that is in a perfect world. What happens? The minute you introduce some managers that aren't going to follow those rules, then you get everybody just saying, nope, everything was successful, it was great, we're perfect. Okay, so it's a slippery slope. If you let people tell you what they think it's worth, and you have anybody who isn't going to follow the rules properly, or there's a lot of flexibility in the rules, then everybody's just going to say the best thing possible, and you're going to learn absolutely nothing that way either. Okay, the last thing that is not recorded is if a company is working really successfully and it's just somehow better, like they've figured out how to structure their warehouse efficiently or how to manage to keep their employees happy. They have, retreats where everyone leaves invigorated and they come back the next day ready to work. That kind of stuff that you can't really measure, that makes the firm better than just all of the individual pieces, is called goodwill. If you develop that internally, we can't record it because we can't figure out what that's worth. The market is implicitly telling you, hey, we're willing to pay more for this company or less than this company than all the individual assets. And so that's a measure of the goodwill. But the only time we can measure patents, trademarks, brand names, R&D, and goodwill is when we actually go and buy it. So if we go and buy another company and we pay more for the company than all of the assets are worth, then we can measure how much we paid for the goodwill. But if we just develop it ourselves by running a bunch of programs which make our employees happier, we can't actually determine whether that's going to lead to supernormal profitability, and we have to expense that immediately. Okay, so when I say we're not including these, we're not including anything that's developed internally. Okay? If it's purchased, so if we go to a company that developed a patent and they're not going to use it, and we want it for our process and we go and pay for it, then we can record it. But if we develop it ourselves, we cannot. So there needs to be an arm's length transaction to say that the amount that we're paying is some fair value. Whereas inside, we could just throw money, we could just basically give $100,000 to all of our employees. They can walk home with it and leave, and we can't actually say we're any better off. Okay, so it has to be purchased in a fair arm's length transaction. Yes? Sorry, can you just, I didn't hear the first part of it. Mm-hmm. Yep. Okay, so the question is, you've got companies where R&D is the biggest thing that they do. So pharmaceutical companies, biotech, even software companies, those are the kinds of companies where they're spending a lot of money on research, and how are they able to communicate to the market how good they are? The answer is they kind of can't, okay, until there is some product which they actually use from the R&D. So what do? In pharmaceutical companies, they will describe in very great detail, this is footnote disclosure, this is optional disclosure, not in their balance sheet, but they'll tell you, here's what our drug pipeline looks like. Here's where they are, the stage of FDA testing that we have hit upon. So that even though we're not allowed to include it on our balance sheet, we want you to see how good this stuff is, right? So it's past the first 2 phases of drug testing, and it looks like a really viable product. So we're always allowed to tell you extra stuff, we just can't put it on the balance sheet. For those companies, the market is basically inferring what it thinks about those intangible assets. Okay, so in companies where there's a lot of internal R&D, the market price is much higher relative to the book value, like the accounting assets, it would be in a company where what you see is what you get. All the assets are fixed and you know exactly what they have and what they don't have. So you're right. It's not that investors are going to rely more on the market. Investors are creating the market price based on what they think those intangibles are worth. Okay, and so that's what, you know, we're calling this a limitation. A limitation is the balance sheet is not super useful here. We have to come up with some measures of intangibles based on things that aren't in the balance sheet. Okay? Yeah. So if you purchase a patent from some other company, you can record it. So it has become a trend for companies to basically own like 40%, not quite the whole thing, of another company. Okay? They don't want to own more than 50%. They own a large chunk of another company, and they basically direct that company to do the research for them, and then they buy it. So it's sort of a way of getting around this rule that you can't record patents. You basically have an R&D shop that's separate, and then you buy all of their R&D from them. Okay? But if you own the whole company, like or 50% or more, then that doesn't work anymore. So you kind of have to, there are some rules and restrictions on how much of the company you can own in order for that to work out for you. Okay? So again, why wouldn't we include research and development from a purely accounting perspective? Are companies doing R&D because they're altruistic and they want to advance science? No, they're not. They're doing it to make money. Okay? So we know there must be some future benefits. However, because R&D has a high failure rate, a lot of uncertainty about what those future benefits are, and it's also hard to see what the path, you know, even if you think you have a great product, whether it's successful or not is still also pretty hard to predict because of those things, and because just because you spend more money doesn't mean you make something good. We do not include research and development or any of these other internal products. Now, let me back up and say there are a few exceptions. So software companies tried to lobby or successfully lobbied the FASB and said, look, you know, we don't have any assets other than the brain power in this, you know, in our workforce, and this sort of like intangible code or whatever that we're developing. So we can't actually, you know, we're never going to show any assets. How are we ever going to raise money? Okay, investors are going to never want to buy our company because we have nothing to show for ourselves. And so because there was some notion that, yeah, some industries might need a little bit of an opportunity to show some assets, software development or software companies had this special rule on research and development, which is as soon as the software hits a particular point of the research process, which is called technological feasibility. You don't even know like what makes something feasible, but as soon as it hits that point, thereafter, their expenditures can be capitalized. So software companies can show some portion of their R&D as an asset, but only software companies, not all companies. Okay, and there are other industries as well that have some favored treatment. So what they do is they just whatever costs they're paying. So once we've hit technological feasibility, then all costs towards developing the product would get capitalized as software assets. Okay, yeah. No. So it's we're spending. We hit technological feasibility, and then only the stuff after that gets in there. Yep. Okay, so if you have, I'm just trying to see. All right. So in some industries, it's maybe hard to say that, you know, if they don't have any other assets, they need to show something for their efforts. So there's this idea that the research and development process is like a timeline. Okay, so first we do a lot of research, and we investigate, will this project work out? And then once we think it will work out, we start really developing the product into something marketable. Okay? So first we do research, then we start developing, and you know, that's not exactly clear when the line when you draw the line between research and development. But there are some rules which say if you have decided, so a lot of times you'll do research and you'll say, no, this isn't going to work out, and you scrap it. Then you do more research, no, this isn't going to work out, and you scrap. So when all of those things, you don't get to include those as an asset. But if you hit the point where you say, hey, this is a great idea, we're going to continue it further. So once we've declared this is technologically feasible, meaning we are actually going to turn it into a product, then from then on, we can include all of the costs as a software asset. Okay? There's another industry, oil and gas, where it's not so much the case anymore because we are way better at exploring for gas. We have just much better machines or much better imaging and much better kind of ways of assessing where the oil is going to be. But in, many years ago, you would have to go and, you'd think, okay, this looks like a promising oil field. And we're going to have to drill a bunch of holes, okay? Now, you drill the first one, and boom, a geyser comes up, like in the, as you picture in these cartoons. That would be great. But usually that doesn't happen. You drill, you get nothing. You drill, you get nothing. And eventually you get something. So the oil and gas industry said, but it costs us so much to explore and drill those first couple of holes, it seems unfair that we can't call all of the cost, because in order to find that one good one, we needed to make all those mistakes. So all of those costs should be included as the value of our asset, rather than just the cost of the successful one. And so they had what's called, there's this oil and gas policy, which is full cost, which means however much you spend on drilling, as long as something is successful, would get added as your asset, versus just successful efforts, which is only the cost of drilling the one successful hole would be included. And so that's kind of a parallel to R&D. You look at only in the software industry, you can only look at the stuff that turns out to be successful, and that stuff can get added. Okay? Whereas in the oil and gas, like I said, that's kind of like an old rule from the 70s. Okay, and the industries that have been really successful at getting their way around these rules have been just good at lobbying. Okay, it's not like they're completely unique, but they have had good efforts and convinced the FASB to make special rules for them. Yeah. If they have a non-wholly owned subsidiary that does the drilling and then they buy it after the fact, then that's fine. They can just record the purchase price. Okay, but not really. I mean, Exxon is doing a lot of its own exploration. It may have a separate subsidiary that does it, but it still owns the whole thing. And because it owns the whole thing, it doesn't count. You can't do that. Okay, so let's get you guys doing more stuff than me. Okay, so now we're just going to talk about, so we know what we can include, we know what we can't include, or at least we have some ideas. Where do we put it? And hopefully you remember from your intro class that you order your balance sheet, the assets section, current versus non-current, and within each section, how liquid they are, so how close something is to cash. So what's always the first thing that's listed as a current asset? Cash, right? Because how close is that to cash? Extremely close. It is cash, right? And then what's next, usually? Okay, so sometimes cash and cash equivalents are the same. They're one line, okay? Accounts receivable. Why? Usually you give your customers 30 days to pay you, okay? So you're going to get cash within 30 days. You might not get all the cash that you intended, so everybody may not pay you, but the cash is going to turn over pretty quickly. What's next? Inventories. Why inventories? Well, because that's the product, that's the stuff we've made. What do we need to get it to cash? Well, first we have to sell it, and then we have to collect the cash, okay? Sometimes there may be something before that or slightly after that. What else would be up in the current asset section? What other kinds of things can I convert to cash kind of quickly? So if I own securities in other companies in a portfolio that I'm actively trading. So marketable securities, if I plan on trading them, you know, let's say I have like one person on the staff who actually, you know, runs a little bit of a portfolio for me. Buying and selling those securities might be something I do with some frequency. That could be a current asset. What other things do I, so remember, an asset doesn't have to mean that I get cash in. It means I could avoid paying cash. So inventory we have, yeah. Prepaid. So I paid cash up front. Over time, I'm not going to have to pay my rent now, which is avoidance of using cash, which is the same as basically a cash benefit. Okay? In order for something to be current, what does current mean? By an accounting definition only. Used within, so we'll receive the cash within a year, or we'll use the cash within a year in the case of a liability. Okay? It could be the case that we are more conservative than that, which is or I don't know about, but I guess it depends whether it's an asset or a liability. We could use the operating cycle definition. Okay? So if I am going to convert my cash into, so let's say I give my customers a year and a half to pay the receivables, then I really shouldn't put accounts receivable as current, okay, unless it's quite clear, all right, that I am using the operating cycle as my measure of current. Okay, so we want to be a little bit careful. There are some exceptions, but for the most part, we want to think about current is a year. Non-current will be consumed over a period longer than a year. Okay, so like the fixed assets, we're going to use them for the next 5 years. They're going to provide benefits because we're going to produce our inventory. Our inventory is going to convert into a sale, and then we're going to basically collect on our receivables. Okay, so let's look at what do we see on a sort of normal company, not just your regular company, like a really good one. So what are their current assets? So they have cash and cash equivalents, marketable securities. Why do they have so many marketable securities? Well, they have so much cash they don't know what to do with it, so they can't just leave it in the bank, so they put it in like other kinds of securities. Okay. Accounts receivable. Now, when you go to the Apple Store, do they say, go home, take the computer, pay us when you get a chance? Or do they even say, pay us in 30 days or pay us? No, they don't. They don't say it to me either. So who are they? Like, why do they have all these receivables? Where are those coming from? Yeah. Okay, so sales to whom? Okay, so sales to universities, sales to second-party vendors. So Best Buy may sell Apple products. They let Best Buy have 30 days. They don't let me have 30 days. They don't let you have 30 days. Okay, deferred tax assets, that's just reflecting the fact that we sort of paid a lot of taxes, and hopefully in the future we might not have to pay as many. Okay, so it's kind of, the way you want to think of it is kind of like a prepaid tax. It's not quite prepaid because it's not that I have an expected expense next year and I've paid it up front. It's that at some point in the future I expect this, not super certain that I'm going to ever get the benefits though. Vendor non-trade receivables, okay, it's just another form of receivable, okay. It's less liquid than our regular accounts receivable, probably because they provide terms of credit which are 60 days instead of 30 days. Other current assets, you got to just look up what those are. Okay, so they'll give you a footnote and they'll tell you specifically what they are. If you want to know the details, I gave you you should go through, printing it out doesn't always work, so you might want to just like look through the slides yourself. But basically, it's not that this is the only thing that you get from Apple. They'll tell you, hey, okay, here's what cash and cash equivalents mean. And specifically, here's what our trade receivables are, here's what our other kinds of things are, here's what our non-trade receivables are. So they tell you. It's not like you have to guess, but you do have to read a little bit, okay? They'll tell you what kind of short-term investments they have. They're not going to tell you, here's our stock picking portfolio. Obviously, they're not going to tell you exactly what equities they hold, what bonds they hold. Why not? Presumably, they're hiring someone quite good at managing money, and they don't want to, that's private information. Okay. On the other hand, they're not going to tell you exactly what they have, but they're going to tell you, okay, here's what we have in our inventory, here's how we measure it. We use FIFO, we use the lower of cost or market, and so on and so forth. Here are the prepaid assets we have, here are the long-term supply agreements. That's it. Okay, it's not, there's no secrets. Okay? What are the long-term assets? So these are the ones that are greater than a year. Sorry? And they had it where else? I mean, why do they have any goodwill? Okay, well, let's talk about that in a sec. Let me first talk about, okay, so marketable securities. Remember, they had some marketable securities in the short term. They also have tons of marketable securities that are not going to be turned into cash in the next year. Again, this company has lots and lots of extra money. It doesn't want to give it back to its investors because it thinks we might need it, we might be able to use it, we can do something good with it. But on the other hand, we don't want it sitting in a bank account earning 0% interest, so let's at least earn something on it. Okay, PP&E, obviously, they don't have a ton of this, in part because they don't necessarily do all their they don't necessarily own their manufacturing, but of course they do have significant property. They have obviously what all of their individual employees are working on, so individual computers that they had to work on. They have their corporate headquarters in Cupertino and so on and so forth. Okay, then they have goodwill. Now look at this. This number is not that big. Where is it coming from? Is this measuring how awesome Apple is compared to, like, so it has all these assets, and is this 896 telling you Apple is worth even more than just the sum of its assets? Exactly. This has very little to do with the brand name Apple or the products that Apple itself is creating. What happened is they bought Pixar Studios, and so that had some associated goodwill with it. That's what would be included there. Okay, so whole purchases. I don't think they bought. I don't know what they bought, but they bought smaller companies. Look at the scale; it's very small, relatively speaking. It does not have anything to do with how awesome, how much the market values the whole Apple. It just has to do with the value that or the amount that they paid for purchasing wholly owned companies. If they paid more than the assets were worth, that is the goodwill that they have recorded. So this is purchased goodwill only. And it comes about when they purchased other companies whole. Now, you don't have to purchase them whole, meaning 100%, but you have to purchase at least 50% of them in order to record the goodwill. Because once you have more than 50%, it is as if you are one company. Okay, here are other acquired intangibles, right? So when they purchased these companies, they may have also gotten with them certain patents, certain trademarks, certain copyrights, certain rights. Those would be included here. It's always better to include them specifically rather. Goodwill is kind of, that's the category which is, we can't think of anything else to call it. And so you like to put it somewhere specific if you can, and then other assets. Okay, so let's have you guys do a little bit of, here's what, if you think about their long-term investments, they just had stocks, they could have property held for special purposes. If they have funds that they're putting aside money to use for certain specific purposes, that will come due later. So like if you put money aside into a pension fund for your employees or a sinking fund to pay off your bonds, that would be long-term. And owning other companies, but not at 50%. Like if you only own, say, 30% of another company, that could also be a long-term investment. PP&E, you know what that is: land, building, equipment, machines. How do we record PP&E? Purchase price minus depreciation. How do we record long-term investments? That's hard, okay? I'm not even going to go there. That's like intercorporate investments, Chapter 21 in KISO. Like we won't get there. We're only going to get to Chapter 12. I mean in Spiceland. So this is not a historical cost. So when you look at your balance sheet, you don't necessarily see every single thing presented as historical cost. So PP&E is historical cost minus depreciation, but investments in other companies, it's actually allowed to go up and down, not just down, okay? Intangible assets, some of them we depreciate, and we call it amortization when they're intangibles, some we don't. Here's just a definition of what these different kinds are. And here are some of their notes. Again, I don't need to read to you their notes. I just want to give you some picture of here are the kind of things that a company like Apple would have in their PP&E, and here's how they measure them. Okay, so clickers. Everyone take out your clickers. I'm going to do a little clicker time. So you'll notice, some of you might have noticed, that what? I didn't bring them with me. I do have some, so I'll bring them next class. So, come on. All right, so what I had to do, oh, come on. Hold on. Yes. Okay, so if you printed out the slides from, before today, then I didn't have these little multiple choice questions because Clicker is, we came up with this after I had already posted them. So now I updated on Blackboard the new version of the slides with these multiple choice problems if you so choose. Okay, so tell me, people, what do we think about machinery? Is it current asset? Is it property, plant, and equipment? Is it a long-term investment? Is it an intangible asset? Or when we buy equipment, should we just record an expense and cash? All right, come on, click in. All right, so there's sort of a debate of 50-50 on is it current or is it property, plant, or is it PP&E? So a machine that you're using in your production process, what should that be? PP&E. Who said current if you're willing to be, and tell me why it might be current? Okay, so there you go. So it would not be called a machine if I'm planning on selling it. What would I call that in my company? No, theoretically you're right. It's just what would I call that? What do I call the stuff that I'm planning on selling? Inventory, right? So equipment, machinery, those are terms that I'm typically going to use for the stuff that I'm using as a fixed asset versus the stuff. So I could be a company like Caterpillar that sells machines, but I wouldn't call that machinery. I would call that equipment. The stuff I would be calling machinery, I would call it inventory. The stuff I would call machinery would be like this forging equipment and the big giant metal works that I use in order to make those crazy big machines. Okay. Goodwill. So is goodwill a current asset, property, plant, and equipment, long-term investment, intangible asset, or an expense? I don't want you to be biased by what everyone else says. All right, so we got most people going with D, a couple people, not totally small number, thinking it should be a long-term investment. So goodwill is sometimes called the most intangible of all intangibles. And by that we mean we don't even really know how to describe it. It is the thing that that makes a company worth more than all of the assets that we can come up with. So we can come up with a patent and say, hey, we're willing to buy this company because they have a bunch of fixed assets, they have a bunch of other things, and they have a bunch of patents. But if we're still willing to spend even more beyond that, that's what we consider goodwill. What would have been another reasonable response, though, for this, for goodwill? How come I didn't see, I was expecting to see a bunch of E's. When I spend money to make my company better, in some way that I can't really define. So let's say I talked to my engineers and I said, the way we're organizing ourselves on the work floor, that's not really optimal. We could reorganize the assets. We could, sort of fix all of the, make the walkways clearer and just make things more efficient. Wouldn't that contribute to the value of my firm? And there's nothing, I don't really know what to call that. That might be, but why can't I include that? So that would be, I would have to expense those costs. None of you are calling that goodwill. Why isn't that goodwill? Like it's making my firm worth more than all of the individual assets because I have them nicely organized. Okay, so you can only recognize goodwill when it's associated with the purchase of an entire firm. Creating it internally, you can't record that. Okay? So if I were to go and spend money towards making the firm somehow better, that wouldn't get recorded. Goodwill is only recorded when it's purchased. Okay? How about marketable securities? Are they current, property, plant, and equipment, long-term investments, intangible, or expenses? And if you think it's more than one, I guess you can vote twice. All right, how come there's 50 bodies in class? I need to see some more clicks. Your clicker's out. All right, I will bring another set of batteries into class. Okay, so a lot of people think marketable securities are current, and a lot of people, or not so many people, think anything else. Okay, marketable securities are generally current assets if you plan on trading them within a year. However, you could own securities that are tradable but that you don't plan on trading within the year, and they could legitimately be considered long-term investments. Okay? Usually, if they're called marketable securities, that's the label that we give to the things that we call current, and we just call the stuff that's longer term, long-term investments. Okay? But both of them are marketable. It could be the same exact equity holding. In one case, you plan on using it within a year. In one case, you don't. And so legitimately, it kind of could go either way. Okay, what about a patent? What should we do with patents? Hold on. I'm going to stop and then start again. Okay, what do I do about patents? Are they current, PP&E, long-term investments, intangibles, or expenses? And if you have more than one response, feel free to put them both in. All right, so a lot of people want to put it as a D, intangible. Can I make a case for anything else? Patents. How about if I'm spending a lot of money developing this patent in-house, and then I go and I get it patented? What would I have to do with all those costs? Expense. Okay, so When can a patent be recorded as an intangible asset? When I've purchased it. When will a patent be recorded as an expense? When I've developed it internally. So I may have incredibly successful stuff. I have a whole list of patents, but they may not show up as patents on my balance sheet because I haven't bought them. On the other hand, the label patent, if it's anywhere, it's going to be long-term in the intangible section. Okay, so land held for speculation. What do you think? Is that something I'm going to include in my current PP&E, long-term investments, intangible, or expenses? Yeah. Okay, so it's land. Should I be putting it in PP&E? Don't I normally put land in PP&E? Okay, but what's different about this land? Right, this is land that I'm not using in my production process or in my operating process. Okay, so if I'm using it just for buying and selling, it's just like any other security that I purchase. Okay, it's like an investment. Generally, land would be a long-term investment unless I'm planning on selling it in the short term. Okay, usually if it says held for speculation, you're thinking holding it for a while. Okay, supplies, current asset. Right? What are supplies? They're just like office things that we're going to need and use in the current period, consume them. If we're planning on buying a 6-year supply of paper and toner, is there any circumstance under which you might label it non-current? Sure. Okay, but do companies usually buy 6-year supplies of paper and toner? No, they don't. Yeah. So land held for speculation would most likely be a long-term investment. Okay. Research and development. Expense. Okay, I'm spending a lot of money to create research and development, but you're not going to see a line item on my balance sheet called R&D. You might see a line item on my income statement, R&D, because that's the actual expense. If you don't see a separate line item, it could be bundled into SG&A. Okay, but this is where it's going to be on my income statement, not on my balance sheet. The cost of internally generated patents, also an expense. Short-term notes receivable, current asset. Okay, so we know what to do with these things. All right, now let's talk about liabilities and equities. They go a little bit faster, but not so much. Okay. Nope, let's do this instead. I feel like I talk too much and you guys don't talk enough. So, okay, here's a bunch of stuff for a company. Here are a bunch of assets, liabilities, you don't know which. You just see a list of accounts in alphabetical order. And we want to create a balance sheet. Now, since we've only talked about the asset side of things, we're only going to create the asset portion of the balance sheet. Okay? We want to have a classified balance sheet, which means we start out with assets, then we have current assets, then we list them in order of liquidity. Moreover, we pool together common kinds of assets like property, plant, and equipment. So we might see machinery, land, buildings. Those should all end up being in one category at the end. Okay, so let's talk about this. Which of these items, accounts payable, is that an asset, liability, or owner's equity? All right, so we're going to, for now, let's ignore that. Accounts receivable, what kind of asset? How liquid? Very. I'm just going to, accumulated depreciation, what's that? Okay, so that's a little weird. It's contra asset. Where does that go? Does it go on the asset side or on the liability side? Asset side. Okay, good. Where is it going to go? After equipment. So it's associated with the land, building, equipment, etc. account, the PP&E. Okay, so what am I going to have? I'm going to have property, plant, and equipment. I'm going to have land. I'm going to have building, equipment, machinery. Total PP&E. Then I'm going to have less accumulated depreciation. And then I'm going to have net PP&E. So this is going to be with the PP&E account. Okay? Cash. Very, very. Okay. Common stock. All right, so we don't care about that right now. Equipment. What kind of asset? PP&E. Where does that go? Current, non-current? Non-current. Okay? Interest payable. All right. Inventory. What kind? Current, non-current? We better sell our inventory within a year if we, are hope to have any plan of success. How liquid? More or less than accounts receivable? Less than accounts receivable, so sorta, but not very, very. Okay, notes payable, due in 10 equal installments. All right, patent. Okay, long-term asset, so non-current. And what kind of asset? Intangible. So if we have a category for intangibles, it should go there. Prepaid insurance. Current. How liquid? Not very, because it gets used up as time passes. It might take a whole year before the full asset is depleted. Now, a month of it might be more current, like the current month is more current than 11 months from now, but nonetheless, it's not super, super current. Okay, so less. And then retained earnings? All right. So let's just put all our stuff in order. Okay, so let's say we have company name. As of 12/31, I don't know, let's make it 11. Okay? Balance sheet. What's another word that you might see for the balance sheet? So what do we always see sort of consolidated statements of. That just means it's all the stuff that that the company owns. Pretty much balance sheet's all you're going to see. Okay? It's going to be a consolidated statement of balances, perhaps. Okay? And what are we going to start out with? Well, we have our assets. Then what do I do? Okay, let's call, and what's my order going to be for my current assets? All right, cash, accounts receivable, inventory, prepaids. Okay, anything else? All right, just what was my cash balance? $154. Okay, then what? Non-current assets. Okay, so what next? Property, plant, and equipment, sometimes called fixed assets. Okay, what are the things, components of my PP&E? Anything else? Accumulated depreciation. So how much was my equipment? And my accumulated depreciation? 30? 34? 34? Okay, so 66. All right, what else? All right, hold on. Intangibles, okay, specifically I have a patent. How much was that? We can go back. Okay. more. Okay, 40. Anything else? Have we forgotten anything? All right, we have 1, 2, 3, 4, 5, 6, and then plus accumulated depreciation, 7 things. 1, 2, 3, 4, 5, 6, 7. Good. Okay. So we have another 106 here. Okay, so